Okay, so welcome. Good morning, good afternoon, good evening. I'm Giuseppe Basile. I'll be your host today. I want to thank Vicky and Adinda to make this presentation possible. And today I'm going to talk about how we reach objectives through money management. Very, very important presentation and webinar. I believe this webinar has the potential to change the way you look at risk and money management, as well as the way you look at your trading. Believe me, if you don't believe me, just stay with me and I'm gonna show that to you. So, okay, so the sound is good. The title is Reaching Trading Objectives in Money Management Agenda. I'm going to introduce you money management, which is also called position sizing. I will then show you the relation between money management and risk management and trading performance in a very, very practical way. And I will also then show you that money management can be used to reach objectives. And this helps changing perspective, because now we don't have to anymore to get take a big risk, 5% risk, or even use leverage, but we can actually use techniques that we overimpose on the trading system. I'm going to show you how. And and in the process I'll also show you what trading is, in my opinion, and what is not. So as usual, risk is the most important thing. When the money is gone, the game is over, and that's the opportunity you have. So be very careful, don't rush into trading. And if you are watching the recording of this presentation, please stop it now and have a look at the slide. So why I'm qualified to talk about money management? Well, mainly because I'm into trading since now 13 years, but also because I'm an associate for IFTA, the International Federation of Tech and Analysts. And in the last 3 years, I actually had three research paper published, and the first one was a summary of my thesis, master thesis in finance, where I actually filled a little gap in the academic resource when it comes to money management. I'm going to show you what I mean later on during the presentation. I've more than 17,000 hours of total market exposure, and I researched the market actively, and in July 2014 also launched fibstalkertrading.com. Have a look at it, and I also have a coaching program in which I teach my edge in trading based on algorithms as well as money management. Now, so let's define money management in the context of retail trading. What is this? It's a technique that we can overimpose on any trading method. So it's independent from the trading method. And it answers the question how much we have to wager, how much we have to bet, how much um, we have to set up our position when we identify a setup. And for this reason it's also called position sizing. One of my mentor, Van Tarp, defines it position sizing. I think he has a trademark as well on that name, which is quite funny. Now, why money management is important? Well, because first of all, it is strictly related to risk management, and money management and risk management are two different things. Risk management is about managing risk, making sure that you don't bet the farm, and making sure that you last long enough in this game to become profitable. On the other hand, money management is about how much. It's about what's the size of the position. Of course, there is a relation between the two. And there is a relation also between money management and trading performance, also your trading return, and I'm going to show you this relation. But, and that's the novelty here, is that there is also a relation between money management and trading objectives. So does it allow me to get there? That's the kind of question that we can answer using money management. That's a very, very important one. Don't overlook this one. So we are going to focus on this in this presentation. Now, money management, how is it plays in the overall trading process? Well, if we use the traditional breakdown in trading methods, money management, psychology, which is the traditional one. I use 7 pillars on the other hand, and I'll talk about that in a different presentation. Well, we know that trading method gets a lot of focus. There's a lot of resources spent in identifying a good trading method. The most difficult to work on is, of course, psychology, because it requires to it requires to work with your beliefs about trading and about a lot of other things as well. And then we have money manager, which I believe is not completely understood. Actually, I think it's not understood at all. So let's look at the relation between risk management and money management. So it's important to understand how do you express risk in trading, and that's very, very important, because the way you express risk in trading actually makes a big difference on how much you are risking, and how much in reality, and how much you are able to make as well. And also, of course, depends on your possibility of being successful in this game. So what's your risk for trade, and are you being realistic? I can tell you that I spoke to the head of sales and the head of American sales and he told me that 22% of forex traders do not make any use of risk management, so any use of hard stop, which as a result wipes them out, because they get margin calls. So the typical ways of expressing risk is through number of people being risk, the dollar risk per trade, and that's something that I prefer, a fixed or variable percentage of your capital account. Now, when you use PIP, if you use fixed PIP, a lot of people do that, but that does not account for market volatility. So you cannot say in all market conditions that your risk is 20 pips. You have to let the market tell you what's your risk based on the conditions. And these only account for how much you're willing to lose. Maybe if if your system is a valid system. And maybe you trade this with a fixed number of lots, mini and micro. I mean, I have students who actually use one lot all the time, and and it's important on the other hand to have a variable number of lots. You can also have a variable number of pip, which typically are accompanied by a fixed number of lots. So is that a good idea? Well, I don't believe so, and the reason is that if you use fixed pip, as I mentioned before, you can be stopped out very often, because actually now a fixed pip does not reflect the market conditions. But most importantly, and hear this is very important to me, every time I'm stopped out, I'm paying for information. I want to extract information from price structure from the market. So if I'm stopped out without extracting information, I'm not spending my money in the right way, which has, of course, also a ramification on how I choose my stops. And the risk on capital is variable when you use fixed pip, because you only have one risk. And are you able to accept that? No, I think that the percentage of risk on capital should be fixed. So we can also express risk in fixed or variable dollar values. Is that an idea? Well, it's easier to accept risk. You know how much you are risking, but still you need to relate that back to the PIP risk. So and that depends on what is your stop, and also need to be related to the position size, so the number of lots. So the point is that, again, a fixed or variable dollar value is not really linked to price volatility. Does not is not related, strictly related to what price is doing. So you cannot just say I risk $100 all the time, or that would be even good. You cannot say I will risk a variable amount every time, unless you have a criteria for doing that. Okay, so the dollar amount still needs to be related to PIP risk and dollar risk, and again might not be if it's variable linked to position size. So that's my preferred way. And before I continue, please write down how many of you use a percentage risk a fixed percentage of your capital? Please give me yes if you use a fixed percentage risk in your capital in your trading, or you plan to do so, or give me a no if you don't do that. Thank you. Please write it down as I go. I do 1% to 2%. Adi, that's very good. Fixed ratio. Yes, 5%. 5% is quite aggressive, I'm going to show you, but if it works for you, I don't recommend that, but if it works for you, fine. 1%, good. So let me continue then. So the best practice is then to start from a fixed risk, as some of you do, very good practice. And of course, the PIP risk is provided by market conditions and timing. So the market itself will tell you how many pips you have to risk. So by having this information, what you can do is that from the PIP, from the fixed risk, you derive the fixed dollar risk, of course, and that's actually fixed. So if you have $10,000, your 1% would be $100 here. Okay, and from the PIP risk, don't know if you can see the presentation. Let me go back to this, and so saying from the PIP risk, then you can derive the variable number of lots based on all the above, based on how much capital you can risk, which is derived by the percentage of your capital, and PIP risk. For some of you, I'm saying something, something basic, of course, but you would be surprised how many people do not actually practice this fixed percentage risk now, and they don't due to lack of knowledge. And typically what the traders do, they do exactly the opposite. They use a fixed number of lots. So they start from the bottom here and skews all the rest, right? Because now that they can control, if they lose, what's the percentage of their capital they lose. So the best practice is definitely using a percentage, a fixed ratio, a fixed fractional ratio as it's called. And if you have a target risk, you're risking, or you're risking less, or you're risking more if you start from the position size, from the fixed number of lots. And typically, people risk more than what they planned at the beginning, if they either plan. Now, in another presentation, I gave you this formula here to calculate from a percentage risk of the account to calculate what's the position size. I'm not going to describe this in detail. You can stop the presentation here and study these formulas. They're very simple. If you need help, you can go to a Passive FX webinar here, Advanced Risk Management for Success Modern Market. You find it in my page. So look for Giuseppe Basile on fxtrade.com and you'll find that. Now, what's the relation with risk management? If we pick a fixed risk, let's say 1% per trade, or we have a 1 unit of our risk, which I call 1R, that's 1% of your capital. So what we have just done here, I didn't, I tricky sneakily actually introduced a simple money management technique. What's our technique? Very, very simple. Risk 1% of your capital at each trade, regardless of the setup that you get. This is a rule, very simple, and this is a money management technique. It's the simplest in the world, probably. Well, there are even simplest. You can actually trade one lot all the time. That's a money management rule, and position sizing as well. Now, this is simple but effective, and it's called, as I said, fixed fractional risk. The interesting thing and simple and beauty of this is that it adjusts with the size of your trading capital. So if your capital goes from $10,000 to $15,000 because now you have 50% of gains, your dollar risk grows and your risk becomes $150, which is 1% of 15,000. And if you lose money, on the other hand, let's suppose that you use $500, so your capital is now down to 9,500. Then the dollar risk shrinks in these adverse conditions because now the dollar index is 95. So simple and beauty. This is a money management rule. Okay, it's a money management technique. As simple as that, it's a money management technique. Next. So what is the relation between performance? Is there a relation between the money management technique that we use and trading performance? As you can imagine, intuitively there is, right? So if I get my R multiple sequence, which is the sequence of gain and losses, which are expressed as a multiple of the unit of risk that I get, I could get something like this. So my system makes 1.2 unit of risk, then I lose 1 unit of risk, maybe my stop loss is it. Then I lose a zero point 0.1 unit of risk. This could be maybe a trade that closes to break even, but I still have slippage and cost. So that 0.1 accounts for slippage and cost as well, and so on. I mean, suppose that I have 3, 6, 10 trades here, and that's what happens. Now, if I risk 1%, my trading system returns are this one, right? I just substituted my unit of risk with 1%, and that's what I get. And that makes actually, if I, in this case, sorry, if I risk the 2%, that's what I get, right? If my unit of risk, this should be 2% here. Sorry for the small mistake here. That's what I get. So when I risk 2%, if my return is 1.2 times the risk, I get 2.4%, and so on. That's very intuitive. So when I risk 1% on the other side, the result of my system are 6.5%. So now this relation between the money management and something I'm mentioning something very simple here. I'm not getting into huge complex concepts here. Now, the relation between the money management and trading performance can be proved formally. And in fact, there is a paper that I analyzed also in 2010 when I wrote my thesis in finance, which actually shows and demonstrates in the academia how important is money management because it affects trading performance. And this paper, the last time I've accessed it, this is the HTTP. I haven't checked that. If you don't find this paper, let me know, and I'm going to provide it to you. So the simple example show that the risk that we assume in this case our money management technique affects the return we get, which is in this example 13%. If we used a 1% risk, we would have a 6.5%. Okay, so with the same, and that's what I'm showing here, with the same R multiple sequence, so the same system. So this sequence here represents my system, my trading system, because that's the output when I apply my trading system to market conditions, right? So with 1%, I get 6.5%. With 2%, I get 13%, which is the double with this simple money management technique. So now the important thing is that you can overimpose different money management techniques on top of the system's rules. And that's very, very important. And I'll show you the ramification and consequence of that, especially in the region, in the department of psychology. And different money management techniques of course, are able to affect trading performance, your return. So study money management is very, very important, and you can get very creative with money management. For example, in another presentation, I showed you the market's money layer, and actually it's the same presentation that I mentioned before. So if you look at this presentation, Advanced Risk Management for Success in Modern Market, you will find the CRP for trader, CPR for trader, that allows you to calculate your position size based on your percentage risk. And also you will find this advanced method here. So let's continue. Now, the good thing is that you can use money management and get very creative with it and use it without compromising your own capital. Remember, I have a rule PPC, protect precious capital. That's our job number one. Our job number two is to find low risk opportunities and actually try to generate risk-free trades. So how can we do all this? So not compromise our capital and and put together best practices. We keep risking 1%. On our own capital, but we can actually increase the risk on on gains, and that's the main, from a conceptual point of view, the main way of going, and that's what I call market money, which are the the gains extracted from the market. I had an example here in that presentation I mentioned before. I'm not going to go into detail into this, but the idea is that by using this technique, you can go and a reward to risk of 5.45 can become a 20% trade when you leverage only 30% in gains. So you can have a look at that if you haven't. It's a very interesting webinar. So let me continue, because here I want to I want to demonstrate a different result here. So how this applies to you. I suggest you keep risking a fixed fraction and accept the risk you get, because sometimes people, they say I risk 2%, but then their 2%, they're not really capable of accepting the dollar risk, which corresponds to that 2%. Now 2% or 1% is very small, so typically that's not the risk. But if you risk 5%, you might not be able to accept that. I also use a confirmation timing, my Phipps talking timing technique, for example, to further reduce risk, and I use that on top of low risk opportunities. And I also employ a risk-free approach. I try to leverage the confirmation that gives me enough movement in the direction of the trade so that I can get 1 unit of gain, which equals 1 unit of risk, and then I get off 50% of my position. And that's the way I trade. Now, I trade trends, like in this case. If there is an area of potential retracement, E, and I identify those areas using the effects of algorithms on price. What I do when I focus on that, I focus on the counter trend move here into that level of potential support, and I study the sequence of measured move that is brought about by algorithms between D and E. So that's my technique. Now, the confirmation level allows me to, which is this second point here, allows me to actually know that there is enough participation from the algorithms on the larger time frame here. They come into this. It allows me not only to let price go above the confirmation level, but also let price go into the risk-free level. And this is a level again where the distance where price travels, and it's the distance between the stop, that in this case could be below E, and the confirmation level, and above the confirmation level. So will be the same sides here. Let me see if I can show this to you. Would be from this distance here to this distance here, and this is my risk-free trade. That helps managing risk, of course, if you can well understand. So I want to show here an example of timing using the Phipps talking timing technique. I won't go into details. I had other presentation where I presented this, but basically this is my confirmation level. So I'm timing a short in this specific example, and I know that there is potential participation of algorithms on the larger time frame in a short here, and that allows me to study the sequence of measure move higher here. You see these three sequences, and the 61.8% of the third sequence is my confirmation number, so my confirmation price. So from here to here, this is my risk, of course, PIP risk, and the same distance from here to here, this is my free risk level. Okay, and that's where I get 50% out of the position, because if the market retraces, I don't have to fear anything. Actually, after I do this, I just go and concentrate on something different. Or if you have any questions so far, please write them down in the chat, and I'll be happy to answer them. So, why a trader gets risk management wrong? I think there's a basic misunderstanding of what trading is. Trading is not a passion. It can start as a passion, but trading is a business. Eventually, you will need to start thinking about it as a business, and the earliest you do that, the better. So what are the consequences of this? People think in terms of a pips per day or week, and they think in terms of salary. And sometimes they want a very huge salary compared to the to the potential. Because if you have $10,000 and you want to do 4,000 every month out of that money, that's a 40% return monthly, which is quite a lot, I would say. But I hear these things all the time. So if you need 4,000 or 10 pip per week or 20 pips a day, that's not, I believe, the way you should actually think of risk management, money management. You might generate income in this way, but you never grow your capital, and that's the objective of trading. It's not generating an income or only generating an income. So why people use high risk like 5%? Of course, the person who mentioned before 5% might have different reasons to do that, and maybe he has a very good trading system with high expectancy, high reliability. So I'm talking here in general terms, but typically what it is that as people have access only to very low reward to risks trading systems, actually that's so between 1 to 3, then they have to increase the percentage of risk in order to make everything profitable and make everything sense out of it. And that's the reason they increase the risk to compensate that. But on the other hand, they should look at ways of managing risk, or a better system that increases the reward to risk, or a better time that does the same, or actually study a money risk management that actually magnify and increases, as I showed you before in that example of the money management layer. Or use risk-free trades. There are a lot of other ways to actually improve that. Actually, risk-free trades would only work on risk, would not work on increase the risk to reward. I have a question here. If 10% risk is okay for others' money, why not for one's own? That's a very good question. Actually, the difference is psychology. As I showed you before, 75% of the world story, some people believe it's 95%, it's psychology. So it's the way you think of your money. You might accept a 10% on a portion of that money if you know that it's coming from gain. So it's mostly psychological, of course. Okay. Now there's a fundamental truth. Anything can happen in the market. So when you risk 5%, you are putting yourself at risk. Anything can happen in the market. Now let me give you and read you this snippet from a professional trader. I found this on a review, and he says you assign a simple percentage value to every trade depending on your risk level. Well, depending on the quality of the trading system as well that you have, because some trading systems allow you to assume higher risk. I'm quite an aggressive trader, so I'll sometimes go up to 5% in a single trade. And I already told you, I wouldn't agree with that approach. Look at what professionals do. A typical hedge fund will risk a fraction of 1%, a quarter of percent or half of percent. Most traders float around 1 to 2% level, which I believe is it's balanced. On the other side, the trader here in this case is a more aggressive and I risk 3 to 5%. And the reason, I don't agree with the reason. I use pure risk capital for my trading. The reason should be because I have a very good trading system with high reliability and expectancy, and it provides me a lot of opportunities. So I don't believe in risk is 1% or 2% per trade and having 90 to 95% of the capital sitting there. Well, it depends. If you use a risk-free approach, you can forget about that trade and go for another trade, for another setup. So you can have multiple setups with certain. So this was just an example of, I think in this specific example, money management is not taken into account at all. And it's a pity because we can leverage the power of money management. So on the other hand, of course, now you understand that I believe in risking 1 to 2% instead. And the difference is how do you plan or do you play the trading game? And that's, the way I would go with it. I would develop or get access to a trading system that, first of all, takes low risk trades. So, of course, the best concept is to trade a retracement and use confirmation free risk trades and further ways to reduce risk. I call these parachutes. Only risk a small percentage of your account and then develop the psychology which is conducted to success. So understand the market psychology, accept the risk all the time. You'd be amazed how many people do not accept risk. They take a trade and then they will realize how much they're risking when the trade is going against them. They just say, oh no, I don't want to be in this game, and then they start second guessing, they don't respect their stop, and so on. Personalize and test your trading system to develop confidence. Psychology is a very, very big part of it. And then keep developing it, following it, and executing it. So for me, the name of the game is to become consistent in generating few percentage per month. You don't have to generate $4,000 per month. You have to generate 3-5% every month. And then what do? When you do that, what we achieved? Well, you achieved a lot, because first of all, you're playing the game in defense. You use several parachutes against risk. You remove, very important from a psychological point of view, pressure from trading, because now you don't have to make $4,000 per month. You have to reach a 2, 3, 4% per month. And when you become consistent in generating that few percent per month, you can remove a lot of pressure. And what do you do next? Well, next you play the game in the right way, which is to leverage gains a monthly percentage return using money management, as I'm going to show you now, to keep saving money to add to your account. And very, very important, use money management to increase and magnify profits, as well as to reach your trading objectives. And use other people's money as well, because once you are consistently generating 2 to 5% every month, now money management becomes also an opportunity to trade and start trading other people's money. And you don't have to have a long 6 months or 9 months can be effective. And so I have here, I start with 5% and reduce it during the trade if possible, of course. How is about this approach? Well, this approach is that you are taking all the bigger risk at the very beginning, when you don't know whether the trade is going to work or not, because again, anything can happen in the market. And that's something I actually said here, and that's a fundamental truth of the market. So if you're taking 5% at the beginning, you are taking the biggest risk at the beginning, and then when the position starts working for you, you start removing portion of your position. So you're taking less risk when your trade is working, while it should be the opposite. So I think your risk is too high, but that's my personal opinion. So let's look at the money managed then. I don't have a lot of time, so I'll go very quick on this. If your trading objective cannot be immediately met, and the reason typically is that the risk is small compared to the size of your account, and also you have a limited experience exposure, so you don't have confidence. Or your execution is not needs to be tuned, and maybe you don't have access to a low risk trading system, which gives you a high reliability and expectancy and a high number of opportunities. If that's the case, just let me know. Look at fibstalker.com and look at the trading at the Fibstalker method. So money management is really the vehicle that can be used to reach your trading objectives. And I will define trading objectives later on. Even if in the face of a small initial capital, but provided that you have a robust trading system and you develop that confidence related consistently. So again, the solution is not risky 5%. The solution is risky 1%, becoming consistent with it, and then use money management to reach your trading objectives, to magnify that. And I'm going to show you how you can do that. So you can do it without any leverage. So you can leave alone the broker leverage, which is, it is a tool that can actually cause disaster, can actually cause you to get in debt, which is something you don't want to do. Another reason for the 5%, I do not agree with that, because if I make a mistake, and Van Tarp says that mistakes, big losses are always psychological mistake. If I make a mistake and I lose a multiple of 5%, now I'm putting in jeopardy my opportunity, which could be unique in life, to make money out of the markets. Once you have profits or you have actually tuned an high expectancy trading system. Now you can increase your risk on all the capital in your account, or only increase risk on the money markets options, which are really your gains. And there are countless ways you can actually study a money management technique. And I love doing that, and it's something that I spent a lot in the past on. So money management can be used to reach objectively, and this aspect can be and has been proven formally by myself. I actually wrote an examination of the linkages between money management and investing goals back in Ireland, the National College of Ireland in 2010, where I show and fill the gap in the academia, because there is no proof that in academia that there is a linkage between trading objectives, as I'm going to define them now. And that's a typical definition of trading objectives. And um, um, you can define different goals or sub goals, which could be protect your capital, downside protection. And of course, when we put money at risk, we are interested in upside potential, right? We could have different sub goals here, and we could also have an opportunistic outcome. Whereas this is an open trading objective in which I say, well, I would like also to have an opportunity or a probability. In this case, I don't define it because I don't know, how this specific system that I use to prove. So what we're doing here, I am trying to give you a proof that there is a linkage indeed between money management and investing goals and trading goals. Okay. Now, this is the way you can define your trading goals or objectives. And as I was saying, the opportunistic income is a multiple of your capital, a return which is a multiple of your capital with a probability bigger than zero. And the goals can be, and trading objectives can be mandatory or discretionary. And the outcome would actually be how much money do you do at the end of the period. So let's say that in downside protection, or how much you lose or make, right? I would say, I was saying here that I want to have only a 1% probability of having a loss of 20% or greater. And that's an event that I call the risk of ruin. So I don't want to, in a period of 1 year, have more than 20% loss. In this specific model, in my trading, I actually want much less than that, 5%. Okay, and typically, that does not happen. So, but this is just an example of the sub goals that I've used in my research paper to prove that there is a link between money management and trading objectives. The upside potential would be, I want to make 40%. And in this case, I didn't provide the probability. A second would be, I want to make 60% in 1 year with a 20% probability, and so on. So that's the way you formally define objectives. Okay. So in my paper, basically, I showed how different money management techniques can be used to control how you reach your objectives. And some money management techniques have limitations. For example, if you trade a fixed lot, you you work very well on one of the sub goals, which is downside protection, because it's very good for downside protection, but actually it does not allow you to easily reach the upside, one of the upside goals. Okay, so despite the possibility to partially modify the behavior of this money management using parameters. Some technique were able to improve sub goals. For example, if you use a fixed fraction ratio of your capital, and there were some money management techniques that had different features which separately affected different sub goals, reaching the possibility to reach different sub goals. So, for example, when you use a number of stock, lots, or contract future forex futures linked to the size of the account. So, in the end, the work shows that good money management techniques are able to modify the results of a trading system, a profitable trading system, in order to positively affect not only trading performance, but also to reach objectives. And now you may be in that phase in which you still do not define trading objectives formally, and that's fine. But eventually remember that trading is a business, and eventually you will need to do that. Okay, and when you do that, remember that money management can actually affect trading objectives. So I'm giving you different reasons to to get involved and understand money management a little bit more detail. So proper money management is as important as, and if more important, probably the trading system itself. So before I get to the conclusions, which is the last slide here, I have, when we risk 1% per trade, how much overall risk we should accept. For instance, if we have 5 trade which have not free risk level, what is 5% of overall capital? Very good question, Kausala, very good question. So this really depends on your trading system as well, and on your testing. But typically between 5 and 10 position is still okay with 1%. Of course, you know very well that forex pair can be highly correlated, especially forex pair against trading against the US dollar. So the number of positions should also be related to the forex pairs you trade. And as you know, I recommend you not only trade forex but also trade stocks and futures and commodities, so that you try to get into into a situation where you are trading positions which are not correlated. Now, there can be times like 2008 when even non-correlated assets all move together. Forex, equity, and commodities, they all moved on the downside. That said, 5 to 10 position is still okay. Of course, testing, money management can be tested, and the result of applying position sizing can be tested. So that number can be pinpointed to the down to the actual number. But I suppose that, not I suppose, I can tell you that 5 positions with a 1% risk, it's very, very much bearable. I hope this answered the question. So how you have to, what we have seen here, you want to to risk low, to have a low risk fixed fractional money management method. You play in defense. I call it PPC again, protect precious capital. And by doing that, by playing defense, so by risking a low percentage, you actually remove stress from trading. Parachutes, what I call risk parachutes. First of all, accept risk. If you risk $1,000 per trade and you don't accept that, you are going to put yourself in big troubles. And the market, is not related to this. That's all related to psychology, your psychology. Accepting risk is about your psychology. You should have a timing mechanism that offers a confirmation. And when the confirmation price is actually reached, and I use the Phipps Tolkien timing technique. So I have a level that I test. I look at the counter trend measure move into this, and the sequence of measure move on the smaller time frame that I get here also give me a confirmation level. And when price gets above the confirmation level, it gives me an indication that the participation that is coming from the larger time frame here, it's strong enough to bring this price into my risk-free level. And the risk-free level is that level, whereas my gain here in this point equals my risk, which is this. Okay, when I do that, I can take out 50% of the position, and I go away and I go to think something different. So this is the concept for free risk trade. And we focus on generating low, consistent monthly percentage gains, as I showed you before. And now we use money management to increase or magnify profits. Okay, so when you hear people saying, you only risk 1%, you'll never make money. Now you can tell them, wait a moment. Well, you are taking too much risks, because too high of a risk, because although I risk a low percentage of my account, I know methods to magnify profits, and I don't have to get 5% of risk to do that. And plus, I don't have a system that only gives me 1, 2, 3 reward to risk. Actually, I have a system that in certain situations, win trades, can give me much more, 20 to 50 reward risk. And that's what I'm looking at. So can you see that everything is connected here? If you have a trading system that generates high reward to risk, you don't have to get higher risk. Okay, very, very important, especially if you're starting. That's very, very important. So use money management to reach your trading objectives, as I showed you before. So your trading objective may be, I want to make 50% every year, and now you are risking 1% on $10,000 or $5,000, which makes you, in a trade, it might make you $500, right? And now you have to get to $50,000. So, I mean, how are you going to do that? Well, you use money management to reach your trading objectives, and money management to magnify profits. Okay, and and if you understand the way the trading game has to be played, at some point you have to start managing other people's money, or saving enough so that you can increase your account. You have now confidence. You have now ways to generate consistent monthly gains. So proper money management in conjunction with a solid trading system helps, even in the face of a small amount of capital, to realize your trading objectives in time. Not in 1 month, while closely guarding risk, which is the most important thing. And that's, really what I wanted to tell you today. I hope that this was interesting. If you got any questions, I think I still have some time to answer them. But see how everything is connected. Your trading system, the quality of a trading system, allows you to be more or less aggressive on your risk. And with money management, when money management enter the pictures now, we can actually reach our trading objectives, but the same way guarding risk, which is job number one. Okay, of not being a trader. So I hope this was interesting. My apologies if at the beginning we had a little few problems there. If you have any questions, write them down. I'm going to answer them until I'll be stopped by Adinda. But I hope this was interesting. This is a very important presentation. Please go back to it, review it, and this gives you a very important. It gives you the basis for a mental shift, for an actual shift in the way you look at trading. Very, very important. Okay, so I believe it's very important. If you have any questions, write them down, and give me a yes if you found this not only boring but also a little bit interesting. Please give me a yes. And again, any questions, I'm going to answer them now. You're very welcome, Daniel, Peter. Thank you. Good, Kosala. I'm happy that that was useful. What I ask you is just go back to the presentation, watch that again as soon as it becomes available, and reflect on the concept that I gave to you. Very, very important how money management can actually change the way you trade, and can shift the way you think about trading into something like this: low risk percentage, always place in defense, protect your capital, and most importantly, when you do all this, now this helps you to remove stress from your trading. Okay, which means that it's easier to deal with it. And now you can add advanced risk management techniques here. Well, accept risk, of course, using a timing confirmation. Like I use the flip stalking timing technique. If you're interested, let me know. and so thank you very much. Excuse me, and have a great day, a great evening, and a great afternoon. And I'll see you soon.